All right, Sam, good to chat here for a second. I think we're seeing tons of questions and commentary, not just in practice generally, but Twitter, search funder everywhere.
Everywhere.
Um, and I'm not sure, like, it's interesting. I'm not sure what your take is on why that is. I almost feel like I'm seeing more and more commentary and like fielding more calls and things like that from people that haven't typically been interested in this space as an investor that are like, well, real estate's gone to shit. I'm a real estate investor. Like, I want to look at the small business thing. Like, are you picking up on that at all? Or am I sort of like making that up? Or like, why do you think everyone's super interested in talking about investor terms, which is our topic here
You know
today?
what? I have no idea. I think I get it more from the searcher's perspective, and I probably get it mostly because a lot of the other topics in ETA are covered, right? Like the SMB guide, the Harvard guide, buy then
Yeah.
build. And yet, like, this is probably one of the more technical areas, and it has to do with economics to the searcher, which is other than the freedom thing and the independence thing, people are doing this to create wealth for themselves. So how do they do that? They
Right.
buy a business and they keep or they raise money and sort of keep as much of the economics as they can. So who knows?
Yeah. No, it's interesting. Well, cool. I mean, we can keep this brief, but I think people are super eager from someone who's been doing this for a while. What are the typical investor terms? What are we seeing? We're even maybe seeing some things changing a little bit as like interest rates and return profiles and things like that
Totally.
change. So let's walk through here a little bit the investor terms. So just real quick overview of a handful of the things we're going to hit, and then we'll dig in. So sources and uses of capital. This is where we always start, right? What are the needs for the project and acquisition, and where's it going to come from? That's ultimately going to drive, do you need to raise? If so, how much, and in what form? Assuming so, what's the capital structure? What are the actual economic terms? And what are the sort of economic levers that investors look for? And then, we'll talk a little bit as we wrap up about kind of what this applies to, because this isn't ubiquitous across business buying. This is a little bit unique to the self-funded space. So let's dig in. If you want to start and talk us through, here's a simplistic sources and uses table that you might see in like a first look investor term sheet. So break down what we're looking at
Yeah, and
here.
look, so searchers, when they're going to model a deal, before they ever even financially model a deal, they should list out the sources and uses of capital. And in particular, the uses are first, even though they're on the right side, which never made sense to me, but whatever. What do I know? We're just a bunch of lawyers. Um, so it's really what's all the capital you need to get the deal done? What is the money, the total amount? And in this case, we call it project cost because that tends to be the phrase that the SBA lenders in our community use for the total uses. And then naturally, all of the uses of money need to match up with sources, right? You need to raise as much total money as you need to spend on the
Right.
deal. So really, like all the uses, and this is generally, there are exceptions. This is just an example. There's cash to the seller at close. There's a seller note. There's a bunch of deal expenses you've got to pay for at closing. For example, the SBA guarantee fee goes in there. So does something
Yep.
like your lawyer, your quality of earnings provider, et cetera, et cetera. And then everybody should put excess cash on their balance sheet, which is another sort of point of disagreement amongst folks, but we'll defer. And then on the other side, when you say, all right, we have a $4 million uses of capital, that's your project cost, you've got to match it. So SBA loan is going to
Right.
represent somewhere between, say, 50 and 90% of the project cost. Seller note matches on each side of the table, and then equity. And here we split it up between searcher equity and investor equity. But in my experience, it's the same form of equity that when somebody puts in cash, they all get the same kind of equity. The searcher
Right.
also receives common equity in the deal, and we'll talk about that later.
Yeah, I get that question a lot, but yeah, I always found that confusing as well when I got into this space. But the more I talk to searchers, I realize people often bring the mentality of, I have a $4 million purchase price that I'm negotiating. So I need $4 million, right? I need $3.5 million of bank financing and $500,000 from investors. And they're not thinking through, no, you probably need closer to like 4.3, 4.4 million to cover your expenses. It's important to start there and then back in once you know that, okay, where's this coming from? Because those things will shift. Your SBA debt may slide up and down. Your investor equity may
Totally. And
slide
let me
up
ask
and
you
down.
this. What's the purchase price in this deal? The purchase price is the cash to seller plus the seller note. So it's a,
Right.
what is that, $3.7 million purchase price? But the project
Yep.
cost is four million bucks. So it's
4 million.
$300K on a
Yep.
$3.7 million deal. That's, I think 10% of the purchase price in the form of other costs to get a deal done.
Yeah. Yeah. No, it's a great point. So typical capital structure. So let's take this $4 million. We'll keep going with the $4 million project costs. Let's break it down. So the equity injection. Our example had 600,000 total. So where does this come from in a typical self-funded search deal?
Yeah, and to be clear, the equity injection can be far more than 15% of project cost. We picked 15% just as sort of a rule of thumb, and you'll hear all sorts of, I won't call it baloney. What's the more politically correct word for baloney? Uh,
Opinions.
Opinions, aggressive opinions. You can bring as little as 5% equity injection to a deal if you have a full standby seller note. But I digress. Let's just choose 15% of project cost as your equity injection. So $600,000 of cash equity needs to be brought to the transaction to get it closed. So you will often see the lion's share of that equity brought to the table by investors, people other than the searcher who's going to become the CEO. And I always suggest that if you're a self-funded searcher, I understand you're also paying for your personal living costs, but you should plan to bring at least 10% of the 15% to the table, or roughly 1 to 1.5% of purchase price to the table. It is just sort of an expectation, although there are 1,000 exceptions to that rule.
Yeah. Yeah. Certainly see deals where bring in almost nothing.
That's right.
Or maybe it's just the project cost, which is, less than what that would be or something.
Right.
Yeah.
So, look, the investors bring the rest, and let's talk about how that gets split up.
Perfect. So the usual math, just to walk through here, if you're just thinking about this back of the napkin, not really thinking about search economics, I've got $600,000 broken down 1090. This seems like pretty simple math, right? The searcher gets 10%. The investors bring the other 90%, but overall that's 15% of the company. So the searcher owns 85%. All of the investors collectively own 15%. Am I thinking about this correctly?
That's what you would think, and that's what happens in the normal world. But we're in SMB ETA. This is not the ordinary world. So, and to be clear, I don't think any searcher would go for that because it doesn't reflect the value they're bringing to the table. And we've sat on both sides of that table. We understand the argument. What are those risks, Kev? Like, lay those out.
The biggest risk that we think of in this space, especially if there's an SBA loan involved, but even when there's not, there's still very often a personal guarantee.
Thank you.
Right. And so in a lot of respects, the searchers, even though they're putting less dollar capital on the line, they're putting a lot on the line that the investors are insulated from. Their risk is limited only to the dollars they put in. These searchers are leveraging everything, right? Retirement accounts, cars, houses, right? Like literally everything they've owned and spent a lifetime building.
So there is a bunch of
so that's the biggest
financial risk, and that doesn't even count the time it took them to find the deal, the broken deal costs they may have incurred or at least risked, and just sweat equity, right? There's a lot of things that fit into this sweat equity headline.
Yeah, 100%. 100%. So then continuing on this concept of equity step up. So we do this and see this a little bit differently in the search community. So taking our $4 million project cost, $600,000 of equity capital, break down what that would look like with this concept of an equity step up. What is that, first of all?
Yeah. So what's interesting is the perspective on the prior slide was that this is a bad deal to the searcher. If you
Right.
only allocate ownership to the extent people put cash into the deal, that's not a good enough deal for the searcher, so it doesn't work. Then on the
No, yeah, no searcher wants a personal guarantee and all of that work running a business for a decade down the road for 10% of the
heck no,
economics.
heck no.
Yeah.
So we flip the analysis here with the step up and say, okay, so if that's not good enough for the searcher, how should we think about the investors collectively, their ownership position? And so what we say is like a step up on gross purchase price percentage. So
Yep.
if on that $600,000 project, equity, cash equity injection, they put in 90% of it, so they put in 540,000. Well, $540,000 divided by a $4 million project cost is only 13.5% of the project cost. So their gross equity in is 13.5% of total capital need. So,
Right.
you know, again, sort of flipping the analysis, how much should the investor group as a whole receive of ownership? And this is where the judgment call comes in. If there's no step up, well, if they put in 13.5% of the gross capital need, the project cost, well, maybe they should receive 13.5% ownership. Well, that doesn't work for investors in those cases. So there tends to
Right.
be a step up to reward the investors modestly for what they're putting in, which is cash equity at risk. And that step up, we'll talk about what market is. It could be 1.5 times, it could be 2 times, it could be 3 times, but let's just pick a 2 times gross equity step up. They're putting in 13.5% of the project cost. Times 2 would mean they're going to own 27% of the business, and therefore the
Right.
searcher would own 73%.
Yep. Again, not taking into account that the searcher may have put in 10% of the equity capital. So in that case, they've got 73% of the business in addition to another 2.7 or 10% of the equity economics,
Exactly.
right?
So that
Yeah.
73% would be the searcher's sweat equity that they get for no
Correct. Right.
dollars. And then they'd also buy their pro rata portion of the 27% for the cash they put in.
Right. So why is that important and why the distinction? Let's go there next and talk about the forms of equity and how this will actually work in practice then. So we've established, and to keep the math simple, let's continue on with this 2x example. So there's a 2 times step up in our example, this $4 million total project cost, $600,000 equity injection. That's now 27% of the overall economics are allocated to the equity investors. How does this work in practice and why does that matter?
Yeah, I mean, you're the better lawyer than me, so you should walk us through this. But I mean, at the end of the day,
I'm putting you on the spot. I'm testing you, Sam.
geez, I tried to forget this a long time ago. At the end of the day, and this is again just obviously it's legal, it's standard, but it's the way that this SMB community has arranged the economic relationship. The investor's money comes in as preferred equity, which makes it
Right.
kind of quasi debt and quasi equity. It's sort of a hybrid security, and it entitles them to a rate of return on their investment before the sweat equity receives any distributions of profit. So in reality, what it means is it kind of acts like interest. The searcher has to
Yeah.
return an interest component that we call the pref or preferred distribution, plus a return of the actual investment itself before the searcher can receive any distributions of profit related to their sweat equity or common equity ownership. So it kind
That's
of
right.
feels like a
And
loan with interest and then equity.
and that's why that distinction between what the searcher puts in becomes really important, because without the searcher contributing capital and getting part of those preferred economics, in most constructs, the searcher would then get zero distributions out of this business until the investors get all of their capital back plus a preferred return, which can also be impractical and unattractive to searchers. And so one of the ways that that's handled is, while that 73% in our example sits behind all of the equity investors, the searcher still has the 10% of the preferred, or 2.7% overall, that they're participating pro rata with all the other investors. So they can still get some distribution. They still get the benefit of that step up. They still get the benefit of the preferred return on the dollars that they invested before their sweat equity kicks in.
Exactly right. You said it great. And I'll add, this came up on Twitter this morning, that in the bank loan documents with the SBA, searchers are allowed to pay this money back to investors prior to paying off the bank loan. So there's no restriction on paying back investors. So it's pretty typical for a searcher who's growing their business and cash flowing to actually be able to take distributions of profit to themselves before the bank loan is paid off.
Which is one of the incredible features and attractive components of the SBA loan. If you're doing, even in the self-funded or independent sponsor space, a conventional loan, that's not going to be the case.
No doubt.
Right. The benefit of these covenant light SBA loans is that they don't have these types of restrictive covenants that financial lenders do. They absolutely will restrict distributions. Excess cash flow always goes to the bank to accelerate pay down of bank debt. So it's one of the amazing features of the SBA loan model in the search community that I think is underappreciated, candidly.
The 30-year fixed rate mortgage and the 10-year covenant-free SBA loan.
That's the two best things, maybe the only two best things that the federal government's ever done.
Oh boy, should we talk politics after this?
Sorry. Let me backtrack that. I don't want to get audited. So let's wrap this up then and address the elephant in the room, Sam. So what are the economics? What do people normally see? We used an example of a 2x step up, but I mean, is that real? Like what are we seeing in the market?
Yeah, and so remember, higher step up, better for investors. Lower step up, better for searchers. And what I always say is these levers that you can pull as the searcher, and remember, searcher presents the terms they would like to the investors. That's typically how it works.
Right.
They can present whatever they want. And we just say, generally, it needs to be reasonable. So if what matters to you, dear searcher, is to own as much of this business as humanly possible, that means a low step up. Maybe on the low end, a 1.5x step up would be on the low end of what we see. And if that's what you want to do, I think that's fine from the investor's perspective. You're just going to need to give on some of the other things. So, and what we see a lot is on a really low step up, because searcher wants to own as much as possible, they need to offer other things like a really high pref rate in order to reward the investors for their investment. As far as that pref rate goes, it used to be 7 to 10 was the likely range. I mean, you've seen rates the last 12, 15 months. They've gone bonkers. And now I'd say, even though I wrote 8 to 12 here, have you seen many single digits lately?
No, it's 10 to 12 is probably the norm, and it's creeping up from 12 as well. I think you're spot on.
Ditto. And then everybody wants to know about comp. What's your CEO salary? Again, like, make it reasonable. Make it depend on your cost of living. San Diego is not the same thing as San Antonio. So just match your town. And you want to flip to the last page?
Yep.
We talked recently.
And then
go ahead, Kev.
Yeah, I was just going to say, and then you've always got this dynamic between what the searcher is able to do and what the investors are able to weigh in on. The investors are going to be keenly aware that a searcher can shift a lot of economics to themselves through comp. So things like paying a bonus, any type of discretionary bonus or things like that, even changes to the salary. Oftentimes the investors are going to want some weigh in. So that's a lever that you can pull to kind of alter these dynamics. But the investors want a seat at the table, because they don't want you, they don't want a searcher saying, we had a great year, we're sitting on $500K of cash, I'm going to pay myself a $300,000 bonus and leave $200K for investors. That's not the intent of a preferred return on investment. They want reasonable bonus comp. So expect some some requests to have a seat at the table and some veto rights on things like bonus comp and things like that. I think the last one here we've already talked about, right? Most investors want to see the CEO or searcher in most cases having a little bit of financial skin in the game, and they're going to want to see 1 to 3% of that total project cost as an actual equity injection from the searcher. It's not to say a deal can't get done with little to no kind of searcher cash out of pocket, but it's rare. I mean, the investors want you participating and having your money on the line along with theirs in kind of that sort of motivating pressure to perform well and generate a good ROI.
So too does the bank.
So too does the bank. Well, wrap us up, Sam. Any final thoughts then? I think that's a great overview. Even if, 30,000 foot, there's a lot of, particulars and granularity missing here, but
yeah, I mean, look,
great overview.
You guys see these every day, these terms go into these legal documents on deals you're closing. So you're super close to the action. You're in a perfect position to help searchers make a decision over what package of levers to offer. And, yep, I guess we teach a boot camp, but, pursuant my investment business and help a lot of self-funded searchers through the process. And in most cases, it's good outcomes. So, yeah, thanks, Kev. That was fun.
Yeah, no, appreciate the discussion. And for anyone watching, shoot us a DM, drop us a line if there are questions. We love talking about this stuff if you can't tell. So thanks, Sam. Appreciate the time, and thanks for joining.
Cheers.